Go.
Welcome, everybody, to the Chinchilla Pickin' Podcast. It is June the 4th, 2023 at 6:03 p.m. As always, we hope to be entertaining, educational, and uplifting because we want everyone to make money. My name is David Underwood, and yes, I know I posted on Instagram that Brandon was hurt and seeking treatment. He is here with me. I was looking for a co-host, Brandon, while you were out. I did not find a co-host, so I'm happy you made it back.
Yeah, same neck injury that I talked about the last podcast, and it just got worse. It got to the point where at one point I couldn't even get myself out of bed. It's a pinched nerve in the top part of my spine on my neck, and the pain is just to the right of my spine, and then it kind of goes all the way down my arm, triggers and kind of concentrates in my shoulder, and makes my hand numb. So it's not a fun thing at all. Pinched nerves are terrible. But they put me on a lot of medication, benzos, naproxen, and then something else that I had to take 6 times a day. So I'm getting there. I'm getting better. Just need to stay better.
Well, there you go, man. I didn't know you were going to go into all your details there, but thanks for sharing. We hope it gets better, and that way we could be more consistent with getting these podcasts out to people, because people want to know what's going on in the markets. A lot's happened the past week. There's been a lot of big headlines. First off, I want to eat crow on the video, but not eat crow, because I said that it gapped up so much I wouldn't buy it. It moved up too high, and I would get out at that time. And it was at, I believe, hold on, I'm pulling it up right now. It was at 380 at that time, 385, 380. It went all the way up to above 400. It's back down around 392. I still think it's overbought.
Yeah.
But I was wrong. It did go up a little bit more after I said that, but I mean, I still hold what I say, that it's overbought and needs to retract some more on that. So that's my one. I need to say I got wrong, but I still believe I'm right long term.
Yeah. So,
if you will.
Sometimes it happens. You identified, I think, the upside risk as being narrow pretty well on it, and just every once in a while people go a little bit too bullish. Look, the Nasdaq's on its 6th straight week of gains. That's the first time this has happened since COVID. And I really think I think this is this Goldilocks moment where people are starting to turn and starting to think this time it's different. And
Yeah.
we get that every time, and every time it's wrong. So
yeah, and we'll get into that later on in the show about the Goldilocks moment and the jobs report and what that has to do, how that affects the outlook going forward. But let's get into the meat here. Rules. Brandon and I get together 5 to 10 minutes before the show, and we tell each other what we're going to talk about. You save and hear the live discussion here on the show. Brandon's going to go first, and then I'm going to end it with more on that Goldilocks, the jobs report, some oil news, and so forth. But Brandon, go ahead.
So I actually, in the past couple of weeks, I bought Pfizer stock, and then I've been adding to it incrementally. And this is the first time I've ever bought a biopharma stock. This is the first time I've ever bought a prescription drug company. The reason for that is that they have to spend either heavily on research and development, or if they're the size of Pfizer right now, maybe they spend a little less heavier, but still heavy on mergers and acquisitions, buying up companies that have already spent the money on the research and development phase. But either way, with biopharma companies, oftentimes you're still losing shareholder equity because of all of the money that they have to spend on one or two of those things. And then at that point in time, if they don't pass the 3 phases for the drug trials for the FDA, then all of that research and development money, most of the mergers and acquisition money, goes to waste. So that's usually why I don't step foot into this part of the game, because that just makes it a little bit more risky. However, I was looking at Pfizer, and I think the last I looked, they were down like 20% or 22% year over year already. They're one of the most profitable biopharma companies. In fact, the operating and margin and net margin are some of the strongest of the peer group, and the gross margin is above the industry median. So if we look at the operating profit margin, 35.78%. Gross profit margins are really good, 68.15%. The most important one here, the net profit margin, is 31.28%. We're still in times of high inflation, so I'm still looking at that net profit margin. I think that's still important when it's over 20%. That means that they've got a good amount of market share for their products. Then when you look at the price to earnings ratio here, this gets a little bit cloudy, all right? Because the price to earnings ratio, generally what it does, it looks at the trailing 12 months, the last 12 months, okay? We all know right now that the pharmaceutical companies are going to be getting less revenue from COVID vaccine as time goes on. It's eventually going to bottom out, and you know, it'll become kind of like the flu vaccine every year. So there'll be a continuous stream of revenue, but it's just not going to be like it was the past 12 months or the past 24 months. So if you're looking at earnings over the past 12 months, earnings over the past 12 months are inevitably going to be much higher than they will be in the next coming 12 months. So I did two things here. I looked at the price to earnings ratio initially, which is close to 8%. And then I then took the earnings of now, the market cap of now, and then divided it by the earnings of 2019. So I think that would actually more represent what the possibility, or whether or not it's overvalued or overvalued.
See, I like what you did there in using the pre-pandemic numbers and trying to determine whether or not you think its value is correct with the PE ratio.
So yeah, because the thing is that you'll often have these times where companies have an explosion of earnings for a one-off or reason, you know, and then what winds up happening is that drives the price to earnings ratio down, and it makes the company oftentimes what we call a bear trap or a bull trap, because people will see that and look at, oh, you know, it's so undervalued, I need to buy it right now. But then it's actually really not, because the future earnings are, you know, priced into what it is right now. And if you look at the future earnings, all of a sudden the price to earnings ratio looks a lot more overvalued than what it actually is. Let me just look here. Price to sales right now, it's 2.33%. That's not bad. That's not bad at all. Price to book 2.14. All of that's relatively in line with a good valuation. 3.74% PEG ratio. It's not terrible either. Let me try to find where I put these new price to earnings ratios that I have.
Hold on. What'd you say the PE ratio was?
7.56 right now. That's the trailing.
That's really low, man.
But the earnings were super high too. So if you're taking the current market cap and dividing it by, you know, the earnings over the past 12 months, it's going to look a lot better than it probably should. Okay, so here's the current price to earnings ratio, 7.56%. But if you take the current market cap and divide it by 2019 earnings, you have the 13.3% ratio. Still low.
Still low, yeah.
Forward PE is even better. Usually, if you're looking at a forward price to earnings ratio for a company that's got really, really good prospects, usually you're looking at a forward PE of 20 or above. Forward price to earnings ratio is 11% right now. So not bad on the valuation side. And I just want to kind of get people into my head, you know, and thinking that sort of the way that I thought about this. Looking at the price to earnings ratio is not the only thing that, because there's circumstances that will oftentimes either make it look overvalued when it's not, or look undervalued when it's not. Here, I think we have a company that looks undervalued versus the price to earnings ratio and the forward price to earnings ratio and the 2019 earnings as well before COVID even hit.
Right. So I want to take a quick break here. So price to earnings ratio, if you guys don't know what this means, if you're listening and you're maybe a newer investor, say the price of a stock was $10 a share, and then the earnings was $1 per share. So it was a 10 times price to earnings ratio.
Yeah, it's a market cap as well.
Yeah.
Market capitalization, which is the the total price of all shares outstanding.
And so if what we're looking at is that price to the earnings ratio is low, that's generally a sign that maybe you need to look at possibly buying this company. Now, I will say that there have been times in the past that price to earning ratios have been low, but the company still dropped tremendously and the PE ratio stayed the same, which is why I agree with you, Brandon, that you need to use the PE ratio in conjunction with other metrics and ways of measuring a company's value, and not just the PE ratio alone. And the one I bring up, for example, is Micron Technology. We have joked about on the show how it's, it's had a PE ratio of $5 at various different levels. It just keeps going up and down, but the PE ratio seems to never change.
Yeah.
So,
if you're looking to hide out in a potential dividend stock, 4.28% is the dividend yield for Pfizer. This is above the pharmaceutical industry average of 3.26%, above the S&P 500 index yield of 1.92%, and on top of that, most biopharma companies actually do not offer a dividend. So this is a big thing for Pfizer if you're wanting to buy it right now and have some guaranteed money coming in based on the dividends. If you're looking at the gross, earnings per share growth, 11.37% year over year. Most recent quarter, trailing 12 months is 13.22%. Now, however, here's one thing that I have to look at that kind of raised a red flag to me. Revenue growth was down 24.73% in the most recent quarter. So earnings going up or revenue going down tells me that this company is cutting and trimming maybe from jobs. I know that they've cut a lot of R&D right now, and that's sort of what's driving the earnings growth. It's not revenue. That's not sustainable, so we're going to have to see it go one way or the other. Either earnings are going to come back down or revenue is going to have to speed back up, which I think it might actually at the end of 2023, but go ahead.
You already covered what the revenue decline was, but it was the COVID vaccinations, because Pfizer was a big push, had a large chunk, if you will, of that share of the COVID vaccinations. And so that is where a lot of the revenue decline has been for them over the past couple quarters, and it's going to continue to decline for them. And because of that, that's why they're making cuts.
Yeah.
Now, and the reason why you don't see a lot of pharmaceutical companies, especially the bigger ones, usually do high dividends or dividends at all, is because they try to, like you said at the beginning, reinvest that money by doing mergers and acquisitions of smaller biopharmaceutical startups that they could go ahead and take in under their umbrella and get those new medications and medicines through the system that way.
Yeah.
So that's typically why you don't see that. So that's not always a good thing to see. It depends on if they have enough money still that they're able to make those purchases. It sounds like Pfizer's still profitable right now, so they're posting earnings. It is profitable earnings. They are running the company well.
They've got $22 billion in cash right now as well. Not
right.
bad.
So I mean, yeah, not bad shape, but I think what they're doing is they're planning for the future there with the job cuts now. Planning that they're going to have less revenue coming in from the COVID vaccination, so they need to make the cuts now so that they can better be positioned going forward.
Yeah. Return on equity right now is 31.66%. So if we're looking
That's
at
nice.
Efficiency, very efficient company here. Return on assets is 15.33%. Return on investment 19.19%. Revenue per employee, that's $1,119,000 and $904. So that all those numbers. I mean, it's just indicative of a company that manages its finances very well.
Now, I'm pulling up Pfizer right now as I'm talking to you here, but like my question is, has the stock moved that much at all? And I mean, how much of a actual return on your investment are you looking for in this? Is this a long term, or are you doing a swing trade, or what's going on?
I'm going long term. This company, unless something changes, I'll be holding it for a long time, probably years and years out. I'm hoping to get 20% out of it in the next 12 months, hopefully.
All right, so it's dropped. I have the 1 year chart up here, and it was at $55 a share back in June of last year and December, and now it's back down to pre-pandemic levels here, man.
Yeah.
So you're thinking that it's going to take another rise back up? Then is
Yeah.
what we're looking at.
Probably not as crazy as it did during the COVID boom, but yeah, I think.
So what I mean, all right. So they have good fundamentals, they have good numbers, they have a good balance sheet, if you will. But I mean, what else is going to drive this? Since we were talking about they're going to have a loss of revenue due to COVID vaccines not being as popular. What's going to drive this back up? Is it just good numbers?
Yeah, well, there's some in the pipeline that we'll talk about here in just a few minutes, but it's also the fact that a lot of biopharma companies, big pharma companies, are heavily reliant on one or two brands of drugs to make them money. Pfizer actually has 8 separate brands that account for more than $1 billion in annual sales. But if you look at those 8 separate brands, none of them contribute more than 14% of total revenue. So that speaks to me as a diverse company. As you know, as far as pharmaceuticals go, they cover a wide range of ailments, not just COVID, but there's prostate cancer, there's all kinds of different things that they cover here. So if one of those drugs, goes, and doesn't pass the FDA approval or something coming up in the future like that, then it's not really going to hit them that hard because they've got a diverse array of things to fall back on anyways.
I would make the argument that the AstraZeneca's, the Merck's, they all have the same kind of arrangement. The Johnson Johnson's, Procter and Gamble's. I mean, they have a drug flow through their system. I mean, people watch these companies' private jets to see where they take off to and where they land to. You could subscribe. You can subscribe to people who follow these companies' private jets when they take off and when they land, so that you have a better idea of what company they're going to buy out.
Yeah.
So there's people that track them, and it's a subscription service. And I would make the argument that there's most of them try to be diverse like that, and I would actually think that that's typically what you see. And this is why when I was day trading biopharmaceuticals years ago, I was day trading the smaller ones, the ones that had that one big one in the pipeline, and I would follow the news and the clinical studies and try to really speculate on which ones were going to get approved or bought out. And that's how I was trying to make some money. And that was a long time ago, and it's very speculative. But it gave me a better understanding of how these things all work. And so I would say that most of the big giant pharmaceutical companies all work in the same. They try to work in the same way.
Yeah. As opposed to Neurotech, which only had one migraine drug, but Pfizer bought them out. Back in October of 2022, they paid $148.50 a share in cash. That valued Nurtec at $11.68 billion, and that was a 70% premium to the pre-deal closing price. But they had an already approved drug for migraine relief in Nurtec, and they had a 17% market share in migraine treatment and 11% in migraine prevention in Q1 2022. I would imagine, I don't have the numbers in front of me, but that's probably grown now that it's a part of the Pfizer family, which has a larger reach than Biohaven and Nurtec did.
All right.
I don't like the price that they pay for stocks because I don't like those. I generally don't like those kind of deals because it takes away from shareholder equity, but I do think in these cases they often make sense in biopharma.
Yeah, I mean they provide that instant revenue line addition there, but it is what it is, man.
Yeah. Total revenues in 2022 were at $100.3 billion. That was up $19 billion from 2021, actually, surprisingly. Pfizer's new oral COVID medication Paxlovid was virtually all of that gain. COVID-19 vaccines and the PFE COVID-19 vaccine Comirnaty I'm not pronouncing it right, probably. That registered sales of $37.8 billion. Only up 1 billion from 2022 though. And like I said, we're expecting that to come down, which is why Pfizer is down the way that it is. They guided down for this. So
Are they guiding up in the conference calls? Because I haven't listened to their conference.
no, they guided down pretty heavily for this year, for sure. And the research and development spend over the last 5-year period indicates a weighted average about 17% every year. So we're looking at a reduction in R&D, and they're probably going to supplement that with a little bit more of M&A activity when the market is good for that, with that $22 billion of cash that they have on hand. So the guidance for 2023, we're in a range of $67 billion to $71 billion, which is a sizable drop from last year's $100.3 billion in revenue. So like that's that 25% almost. Actually almost a 30% drop. And that's on the top, that's on the top number. That's if they hit the top part of their guidance. So pretty big drop in revenue there.
Yeah, but they used some of that COVID money, sounds like, to buy the neurotech company, and that's what I would have liked to have seen is instead of paying out dividends, use that money to go ahead and buy up these other companies, and build a big base and get some of these smaller ones to build a pipeline.
Yeah. So actually, the stock is down 27% in the past 12 months. Now that I'm looking at it, I can see it now. One of the things in the pipeline that I'm looking at right now that is very positive for anybody that's got any cancer in their genetics, especially prostate cancer. They've got a drug called Talzena and Xtandi. This is a combination between these two drugs, actually, that was being studied. Data shows that there's a 37% reduction in risk of disease progression or death in men when using this kind of treatment. And then it was granted US FDA priority review because the FDA is looking at these tests and they're saying, well, this is going really well. We should speed this along. However, even better, if you combine Xtandi with Astellas, you get significantly reduced risk of metastasis or death by 58%.
That's a big drop there.
Yeah. Now, if you have treatment with Xtandi plus a drug called liraglutide, and Xtandi standalone therapy reduce the risk of PSA progression by 93% and 67% respectively, compared to placebo plus the drug liraglutide, if I'm making any sense. Anyways, this is all great news. That's a huge deal. If you know anybody, I know somebody that passed away of prostate cancer. Cancer sucks. But decreasing the death rate by 58%, if that's something that they can do, then it's not going to make as much money as the COVID-19 vaccine, but it'll for sure make news waves.
Yeah, I mean, and that's what we hope that's what all these drug companies are in the business for, is to help and change lives. At the same time, they have to make money in order to pay for these new drugs and doctors and researchers. So I don't want to go down that rabbit hole there, but it sounds like you have a solid buy on this long term, holding it. You believe in the future and the pipeline there.
I think so. It's my most controversial buy of yet, because
I don't think so. I still think Activision is still your most controversial buy.
That should have passed.
All right, man. What else you got?
Robinhood recently reported earnings. And the risk of default here from Robinhood that I was talking about last year, it's not as severe as I thought it was, but there's still moderate risk here. They've actually got some liens out on them against their debt from their creditors right now. I think when I was looking at it before, I don't have these numbers specifically in front of me. Their average paying of debts is about 17 days late, so that they don't really have anything reported to credit or anything, but they're usually 17 days delinquent, which I will say this: March 31st, 2023, they reported a revenue of $441 million. That's awesome. but the net income was negative $511 million. So take out all the expenses, doesn't look so good.
And
Revenue,
so they're spending twice as much as they're getting pulling in.
yeah, yeah.
So now here's my question:
Oh,
Is this because they've done free stock trading, A, and now they are also doing this 4% yield on savings accounts, B, and they're pushing the envelope here of how to make people money with who don't have a whole lot of money to make money. And do you think they're pushing it too far with some of these I don't know what you want to call it, but some of these benefits of having a Robinhood account.
possibly. I mean, there's still. I mean, what they came around like what 2012 or something like that.
Yeah.
They're still kind of in their growth phase and still trying to take market share from Charles Schwab and others in a fairly competitive environment. Um, so I think you can justify some of that stuff. But I mean, if you looked at like the revenue um, last year over the 12-month period, the revenue was only $299 million at the beginning of 2022. So it did increase, a good amount to $441 million. However, their net revenue went even further negative because net income was negative $392 million last year, and now it's negative $511 million. So expenses just continue to increase. I think the user base of Robinhood has dropped because I think the market has gotten a lot harder over the past year, and that a lot of retail investors have given up.
Yeah, well, the market has all right. So I want to make a correction on a couple of statements here. The market has not gotten harder, Brandon. The market has gotten back to normal, and this is where you and I have traded at for years. Is in these type of markets. Before we started doing this podcast, before we're doing the Facebook page that we had there for a while, that group. Before we did all that, we were trading in this. This is normal for us. What it was is a lot of people got into the market during 2020, and you could throw a dart at a board and you could probably be correct, and it was going to make you money. And people, we joked when we first started doing this podcast, we joked that it was easy. Anybody could have guessed right and made money. It was just too easy. You're picking gold off the street during that time, but now it's back to normal. We said that this would come. And I think people are realizing this is harder than what they thought it was, and they don't know how to properly judge companies or value companies and properly judge the macroeconomic events of the day and how it's going to affect things. People chase the dragon, as we call it on this show, a lot, and they chase when a company gaps up, they try to follow it, thinking it's going to go to the moon, and there's not all that money behind those things anymore. And so that's what I think that is. And yes, Robinhood's user base has gone down, but I would like to know what they're spending their money on. I would like to look at the earnings report. I did not have time. That I did not know you were going to bring up Robinhood. You caught me off guard with that one, but I would have liked to have looked up their actual earnings report and see where the money's going. Like, what are you spending this money on that we are doubling what we're spending versus what we're pulling in?
I don't see any advertisements, so I don't know, to be honest with you.
Right?
This is
Yeah.
something I could dive deeper into. It's just, I think, Dave, you started investing or at least getting to learn investments kind of more closer to the .com crash. Am I right about that?
It was after the .com crash. Yes, I had in my early 20s, I had come into a little bit of money, and someone I knew was a stockbroker and said you need to invest it, and I went ahead and put some money in and lost it all, and I learned from my mistakes. But yeah, it was after that. It was before the 2008 crisis, but after .com.
Yeah. So, and then when the 2008 crisis hit, and we a lot of us poured money into the market during 2008, thinking everything was going to be great, but then we had another crash in 2010. And it happened to be one of the toughest markets to invest in, despite the fact that if you bought in 2008, these good companies like Amazon or Apple, or any of the mega tech companies, that you'd be pretty well off by now. But the fact of the matter is that it was so hard to hold, especially I think it was harder for me looking at the 2010 crash because I didn't expect it to happen. And I wasn't, very experienced. But now in my investing life, I look at that as a strength because it's so funny because we were just talking about how for most people the market right now is hard. I'm doing better than I ever have over the past 12 months with my investments because this is kind of what I got bred into doing. This was where I started was this. Whereas I think a lot of retail investors started during the COVID crash when there was no place to go but up
Right.
and way too much rampant speculation.
Yeah, very, very too much speculation. And I mean, I like to think, Brandon, that you have your experience underneath you, and now you are a more savvy investor, and you realize a couple things, and you're moving forward with them, and you do what you do. And I always tell people, like, when people come out and say, "Hey, have you thought of doing this kind of option, or doing this spread option, or this thing here, or buy and sell in this market and these penny stocks?" I say, look, I do what I do because I'm comfortable with it. I'm good at it. I'm experienced in what I do, and I don't try to shake the boat because it's making me money. So I'm not going to go out there and try to reinvent how to trade stocks. I'm going to just do what I do because it's working. And I'm going to continue to do that. And I'm comfortable with that. So I don't do a whole lot of options. Very rarely, a few times a year, do I do options, but I stick with just buying and selling stocks. And I think a lot of people during 2020 did a lot of options thinking that it was quick, easy money. I can make a lot of money real fast. And they found out the hard way.
Yeah, they did. And the funny thing is when you're doing it, either the way that you do it when you buy and sell and do swing trades or day trades or whatever, or the way that I'm kind of buying and holding now, all you need is a couple of great winners. That's it.
Yeah.
And you can have a diversified portfolio and have some major losers in there too. But if you've got 2 or 3 companies that are just really kicking butt, you're fine. And that's kind of where I'm at right now. I've got, a handful of about 10 different stocks. Most of them are doing really well. I've got 2 losers right now, RH being one of them, unfortunately. But
yeah, I got 2 losers for me as well, Intel and Cooler.
Meta, General Electric, GE Healthcare. Those are the companies that are really pushing me forward right now, and Google. So,
yep. So let me transition now. I'm going to do a hard transition. There's no smoothness in this. We're going to transition over into, I want to talk a few minutes about the most recent jobs report and what that has to do for the rest of this year and where we see things landing, right? So the jobs report was a very high number. When I look at this, I'm trying to see, okay, where are all these jobs being created and how is this going to affect everything? So it was professional and business services. They led the job creation with a net of 64,000 new hires. The government helped with another 56,000 jobs, and healthcare contributed with 52,000 jobs, right? Leisure did finally come in there in 4th place, and so that was the one I was really looking for. Where's leisure? Is leisure gonna win the way? And hospitality, were they gonna lead the way? And they were not leading the way. It was professional business services. This goes back to the thing I've been saying now for 1 year, and this goes back to I want to look at the number of total amount of jobs available because I didn't see that in this jobs report, and I saw it in last month's. To where the total amount of jobs available dropped by over 1 million last time. I didn't get a chance to look into this report to see where the total amount of jobs available landed. I would like to see that because I would like to know if it dropped again. If we are just filling in these jobs, but we're not creating any more, we're filling in where we needed to hire. So now there's not this, oh, we don't have enough people. We don't have enough people that we've heard for a number of years. It's finally everywhere's filling up. And I wonder what the total amount of jobs is. And I did not see that, but I am going to find it for us so I can talk about it in next week's podcast. But that's one thing I'm looking at to see if the total amount of jobs, Brandon, dropped again. Then this goes back to what we've been saying, that this is just people re-entering the market. They're finally settling on a job. They may not be happy with it, but they have to take a job right now. And so they're taking the job that they can get.
It looks like to me, I looked at it before, and what I can remember, out of the top 5, 2 of them were, one was leisure and hospitality, and then another significant increase was government related jobs.
Yeah, government came in second. They created 56,000 jobs.
Yeah.
Yeah. So, I mean, there's been a lot of job cuts. There's been a lot of downturn in companies, right? consumers are spending, but they're using credit cards and they're using things like Affirm to go ahead and continue the spending, which I don't think is going to hold up in the second half of the year once if the current administration allows the student loan payments to resume. People are not going to be able to make the student loan payments and these credit card payments and of companies like Affirm payments. So I see a slippery slope going forward. It's good that we're creating jobs, but unemployment did tick higher, surprisingly, even though we are still creating jobs at a nice, hot, and heavy pace here. Unemployment ticked a little bit higher to 3.7%, which is good for the inflation front. We still don't have inflation down to 2% level, but you want to see unemployment go higher so inflation come down. That's typically a good sign there. So I think, Brandon, this points more towards a soft landing, and it all depends on consumer credit spending for me is what I'm looking at. And I want to see where the total amount of jobs are. I don't have those two numbers. And if I did, I could have a better idea of whether or not this points for a soft landing. So I'm actually being contrary to what you said last podcast.
So I was looking more into like sort of the history of inflation again the other night because I'm a nerd. That's what I was doing for fun. And you generally don't really have a inflation catastrophe until it's sustainably above 10% year over year. And then once you hit 15%, you start to flirt a little bit more with a monetary catastrophe and extreme devaluation of the US dollar. Once you get to 20%, you're there and inflation. So we're not anywhere near that. I think a lot of people, if you're starting to talk about recession, they compare it to 2008, which was the first global recession since the Great Depression. So 2008 recessions don't come along that often. Whether it's a soft or a hard landing, it's probably not going to be as bad as 2008 was.
Okay, I agree with you there. Yeah, we can agree on that. And I think inflation is coming down, and even the Fed believes that inflation is coming down, and they got a good hold on it. They're probably a little more dovish than I am on their hold on inflation, but I do believe that they have made some progress. We are nowhere like the UK is right now. The UK is still struggling with extremely high inflation there, and Europe's still higher than us. We've brought ours down faster than all the other developed countries, if you will, with inflation. So I think we have a good job there, and the economy is staying strong. But I'm worried about the fact that the economy is staying strong because of credit. It's not staying strong because of cash, just staying strong because of credit. And that's where I've always mentioned my concern is. I brought up the Apple card and the troubles they've had there, and Goldman Sachs and the losses with the Apple card because of subprime borrowing. I believe we're going to have the same thing. And it's going to be because of companies like Affirm. And it's going to be because once the student loan payments start going back in and people are being forced to make the student loan payments, that's what's going to trigger a lot of these credit cards and other companies to default.
I got a couple things to say about that. So
First
of all, let's tie this back into what I was talking about with Robinhood. Those people that have that those high, low credit ratings and high debt. What investment app do you think they're using? It's Robinhood. The Robinhood base will be affected more severely by having to repay student loans or by a credit crisis, even if it is small, than anybody that uses Charles Schwab, TD Ameritrade, or International Business. What is that? International Business? I forget the international one. You know what I'm talking about?
I do.
Top of my head. Okay, so those people that are using those investment vehicles aren't going to be as affected. So that's another reason why I'm staying away completely from Robinhood. But as far as what you're talking about, I think we need to try to find a different way to manage debt here in the United States. Clearly for the country, but also for consumers, because it's crazy to me how the people that are in the most debt are the people that continuously pile up more and more and more debt. Because what winds up happening is these companies that, maybe become super bullish and go into Goldilocks mode, these credit card companies that may think that what happened in the past isn't going to happen again in the future, they start going after the people with a low credit rating so that they can charge them higher APRs.
Yeah.
And then the same thing happens on an international scale, which is incredibly interesting to me. The countries that are worse off and that are least able to pay their debt have higher debts, because you have the JP Morgans of the world. I'm not targeting them specifically, but these big global banks and even people that belong to the IMF start saying, oh, really, I want to loan some money out to Argentina, like they did in the early 1990s. A bunch of Argentina loans go onto them. And then what happened in I think it was 98 or 99, I could be off on my year there, Argentina defaulted because nobody was paying attention to the risks. We really need to do debt differently, is what I'm trying to say, because it's really a stupid thing that the people that are least able to pay the debts have the most debt, and the countries that are least able to pay the debt have the most debt as well.
Yeah, and well, I think as far as America, because I think you're talking about the global country debt is different than what American consumer debt here is, because I believe here in America, not all of it, I would say a good percentage of that debt you're talking about, of people who are least had the worst credit and all that have a large amount of debt, they're trying to keep up with everybody else on Instagram or Facebook or social media and TV and the what like, and they want to. They're trying, so they get in debt in order to have the nice image or things or trips or what have you, rather than doing it correctly.
Yeah.
And I believe that's where a percentage of it, I would probably, if I had to throw out a guess, and this is strictly off top of my head, just a guess, if you're listening right now, probably 25-30% of American debts because of things like that. And that's a behavioral issue with Americans. And that's a behavioral issue that probably needs to be adjusted and changed. But as far as what I'm talking about, investing, I'm looking at, this is going to hurt the finances and the financials market and sectors later on in the year. Not right now. I believe that you're still going to have a bullish run in the banks right now, because JP Morgan put out the fire of the First Republic and all that, and that's all gone now. So I believe you are going to have some positive news in the banks right now in the short term, but I believe in the 6 to 9 month realm, somewhere around there, you might see some hard times ahead if the student loan payments resume, which they have to at some point. We can't just that's trillions of dollars. I don't know where you're going to come up with. I mean, I don't know. I just looked at the debt ceiling, $31.9 trillion for our balance sheet. That's insane. And then I don't know if you're going to add double that to pay off all the student loans. And I mean, this is just, I don't know where you would get the money as a country to pay that off. I think we do enough reckless spending as a country, but I don't want to get political here. I feel that that's going to be a trigger, if you will, later on that will put us into a slight recession. Yeah, small.
For sure. It could be. And that it's just, I don't know, I guess it's just human nature. And I'm hardly ever one for any rules or regulations or anything like that, but something has to be done because we don't have the right kind of incentives in place.
We don't. And so what I'm saying is, guys, financial sector, goodbye right now, but don't hold it for long, because you're going to have a downturn unless you're a very long-term investor, like 40 years, then okay, Berkshire Hathaway. But if you're not that, then I would say, this is a more shorter trade, and then don't hold it in the second half of the year. But that's my only say on that. That's what I'm watching. And I do want to get that number of total amount of jobs available to see if it dropped again, and see how that affects the market as well, because that's a big number I want to see.
It'll be interesting to see if the Federal Reserve raises interest rates again on June 13th, which I think it's June 13th and 14th is the meeting in June. And I think I think the market is expecting it to not happen.
Yeah, they're expecting they're not saying that the Fed's going to quit raising rates, but they're expecting it to take a pause on this next meeting and not raise it at all. The only possibility that I've heard out there for a raise was a 25 basis point raise, if they do at all. But the market is priced in not raising rates.
I do think, though, I think it's priced in not raising rates right now, and maybe a fair value for that condition. But I do think that if the Federal Reserve does pause on rates, then we go into Goldilocks, like real Goldilocks mode. And we have a run that nobody that's listening to the show should touch at that point.
Right? Yeah. Yeah. I mean, I would day trade, but
Yeah,
I have very particular. I have a day trade and watch lists, so I have very particular ones that I know very well in and out of the company that I know like the back of my hand. So, yep.
that's the way to do it.
All right, guys. We hope you've enjoyed the show. Brandon, final thought?
Yeah, if it does rally, if the Federal Reserve doesn't raise rates in June and decides to hold off just to see what the extra, side effects of the largest rate increase in probably history is, at least since the 1980s, then yeah, I think it's going to go on a run. But I think right now you can sort of cherry pick what you're buying, kind of like what I did with Pfizer. Just look at stocks that you think are undervalued right now and buy them up. But if we go on a hot rally again, it's been 6 weeks already of the Nasdaq being up. So that's why I didn't buy a tech stock. But if we go on a rally again, don't chase that dragon. Not for a long-term buy, at least.
There you go. I'm gonna leave you guys with this. I have someone recently who I started working with and trying to mentor and invest in, and they didn't even have a 401k a year and a half ago. They have a 401k now. And they were they started taking just $20 a paycheck and put it into out of each paycheck, and it automatically gets deposited into a Fidelity account, you
Nice.
know? And I was like, yeah, right. Brandon and I are both nodding head like, yeah, that's great.
Yeah.
If you're listening and you're like $20, that's nothing, right? Yeah, right. Well, they've been doing it now for a few weeks. So a few paychecks, I mean, sorry. So they got like, 60, $80 in there now. And they also came up to, and they said, this isn't a lot of money and not a lot of thing in here. And I said, all right. I said, 3 months ago, how much money did you have invested in the market? They said hardly anything, nothing. Well, I mean, nothing, because she didn't have anything, right? Just 401k. I said, well, what do you have right now? And she looked at me like, $80. I'm like, okay, you're already doing better than you did 3 months ago.
Yeah.
I said, you got to take that first step and build something in order to go ahead and grow it for something else.
So think about that in a way of percentages, not, just regular dollar amounts. And then start to understand that over the course of a long period of time, the interest rates start compounding as well. So that initial $20 that you put in eventually becomes $1,000, which eventually becomes $2,000, which eventually becomes $4,000, and so on. You have a lot working in your favor when you have, a long time period in a 401k.
And that was where I went with it. I said, now 10 years from now, imagine where you're going to be based off the things you're learning now, and that you're building an actual investment account on top of your retirement account.
Yeah.
Because your investment account, you could take, and if maybe you get into real estate, you could take that money and invest in real estate, or you can invest in a business, or you can invest in all kinds of other things. But you would never have had that investment account if you didn't take that $20 a paycheck and automatically deposit into your brand new Fidelity account and start growing it.
And you're losing money if you put it in a savings account these days. So because you're losing purchasing power with every day that goes by with inflation still elevated.
Right. Inflation's above 4%, and the highest interest rate return on the savings account is 4%. So you are losing money.
And it's so easy that if you're paycheck to paycheck, but you've got a little bit of money in the savings account to say, I could go ahead and get, this $5 Starbucks drink and dip into my savings a little bit. But once you've got it tied up into a 401k or into any kind of investment account, really, then it's much harder to take out. So you're really saving more money doing it that way anyways.
Right. And so that's what I want to leave people with, is you got to start somewhere, get that ball rolling, start investing in somewhere. We've given you guys lots of long-term good investments on the show. And take any one of those long-term investments that Brandon and I believe in and have long-term belief in, and just, put some money in it, or do your research. Go on our website. We don't have much on the website. It's a very simple website, but there is an article on there about how to value a company. Read that and use that to value companies out there and find the ones that are valued right for you. All right, we don't want to drag this on anymore, guys. So as always, we hope we've been entertaining, educational, and uplifting because we want everyone to make money. Have a good night.
Have a good night.